Good morning and welcome to the Killik podcast for Friday the 6th of March. This podcast we're going to talk more about the stocks, but we'll briefly touch on some economic issues. This week we've had the ECB moving towards bond buying next week. We've also got a big jobs report number from the States coming through this afternoon. So we're continuing to see this dollar strength against euro, which has been good for the European markets, and we're seeing inflation expectations start to pick up in Europe, and the economic surprise index, which we've looked at on a number of occasions now, moving towards that extended territory where the actual results are beating analysts' expectations. So that's all very good for driving European markets, and we've seen that particularly in the cyclical sector of the market, where European cyclicals have outperformed the market by 11%. With 90% of all European cyclical names beating the market on a 3-month basis. So that's a very strong performance. None less so than VW. And here we can see the re-rating that VW has experienced since October. So the P's gone from 7 to over 10 times earnings. We had some numbers from VW last week, and the guidance was slightly below expectations, although current year numbers beat expectations. And we're just looking at the overall EBITDA number on VW and seeing some pressure coming into that. So it's just prompted a slightly wider look at the sector in aggregate. So one of the reasons why people are buying autos is because they're a consumer sensitive sector. They're also sensitive to Chinese growth rates. And so in terms of the consumer concern, that's diminished because of lower oil prices and easing financial conditions. What we're trying to look through is the secondary effect of that. And we feel actually probably the overall additional contribution from lower oil prices is limited in the context of the total addressable market. And there will be secondary effects from lower incomes in emerging market, sort of oil-producing countries that will affect overall sales. So we don't want to get too carried away with that as a driver. Equally, credit availability for these firms has already been very good. So QE bringing bond yields down isn't necessarily going to increase their ability to raise finance at attractive rates that much. Just looking at in terms of the overall valuations, we mentioned 10 times for VW. That's still, in absolute terms, a pretty low level in terms of the PE, but we do look at earnings momentum, and autos do trade on earnings momentum, and we must recognise the fact that the global auto earnings are at record levels and peak margins last seen in 2006-07, which wasn't a great entry point for the sector. There are also some longer term issues that we just need to be aware of, such as carpooling, emission targets, and also new entrants into the market. So this is a very dynamic market, and this week we've seen talk about Apple Car coming into the market, Apple producing a car. That seems fairly outrageous in terms of a basic statement, but if you look at the total addressable market, it's 1.6 trillion annual car revenues, new car revenues, against 400 billion for smartphones. And the average US driver spends around 25% of his time in his free time in his vehicle. So it's a fertile hunting ground for the likes of Apple. And Apple are already in cars through their software, through CarPlay. And as we move towards autonomous motoring, it's estimated that around 60% of the value in a new autonomous motor will be in software rather than hardware. So it's definitely an area that we expect to see new entrants in, which will put further pressure on the traditional OEMs. Other things in the news this week, we had a big announcement from AbbVie, who are buying Pharmacyclics, which is a US biotech, for $21 billion. There were around 3 bidders for Pharmacyclics, and just underlining the attractiveness of this small molecule, as in orally pill-taken cancer treatment. So just worth reiterating the fact that we like this sector. Just in terms of a growth sector, this is the cheapest growth sector in the S&P in terms of PEG. So the PE is around 15.6 times next year's earnings, with a compound annual growth rate of 17.2. So that's a PEG below 1, which is very attractive in our view. We've also written a couple of update notes this week. Firstly, Visa, and I think it's just sort of fleshing out the sort of most important point, in my view, in that update note. And that is that we are seeing this structural shift towards more card transactions, and that's been accelerated by legislations we've talked about, by Apple Pay and mobile transactions. So here are some numbers. This is a Nielsen report. We're going from 469 billion is the target in 2023 from the current 187 billion in 2013 in terms of the transactions. And the great benefit for Visa is that they earn a per transaction fee. So they're getting 8 cents for every transaction that is made. So that represents a revenue opportunity of around $37 billion. Put that into context of Visa, they have got 60% of the market share, which equates to about 22 billion in additional sales opportunity. Their current sales are around 12 billion. So this is a massive move for these stocks. It really moves the needle, and we think it's still right to be buying these kind of stocks up at this level. Equally, we reiterated Disney. It's just worth sort of fleshing out something along on that stock, and we've just chosen to choose Marvel. They bought Marvel in 5.5 years ago for $4 billion. Film receipts to date have been $6.25 billion, and they've got another 10 films planned through to 2019. Here's some of the films they've produced. But what it's doing is it's really improving Disney's box office stats. So now they've had 4 over the last couple of years of the top 10 box office hits. So that's really driving revenue progression, and that's a model that we like. We like the content model, which we've reiterated a few times. So next week on Monday we've got WPP. This is one of our key stocks. The free cash flow yield on WPP is around 7.5%. They're looking to target a 50% payout ratio. I feel there's a lot of good drivers in WPP's business model. We've got eSure and Prudential on Tuesday. We'll talk about Prudential in a bit. We've got, of the other Killik stocks, that's about it, but you can see there's a few others reporting during the week. Just on Prudential, I feel this opportunity is still very real. In developed markets, insurance spending is extremely low. And what we're seeing is, as their incomes grow, we're seeing a big increase in demand for insurance, for savings and protection products. And Prudential is the market leader, but in most countries it has the ability to grow around 5 times. So here you can see the insurance spending per capita in some of their key markets. And as you can see, it really tails off. And I just want to focus on Indonesia, which is about quite far down that level with $77 per capita. Indonesia has a population of 247 million, GDP of $874 billion. Prudential is a market leader in this country, but it has, quite staggeringly, 227,000 agents in 147 cities and 27% market share, 25% market share. But as I said previously, the per capita spend here is still extremely low at $37. And if you put that per capita spend up to what they're now spending in Malaysia, the additional revenue opportunity is a movement from $14 billion to $84 billion. So that's a structural shift story, again, that I think will play out over the next few years. And that's why Prudential is still, in our view, pretty cheap. So that's it from me. Have a good weekend. Thanks.